The digital currency Bitcoin currently commands a price of $37,000, having more than doubled its value since the start of the year. This surge defies a landscape marked by multi-decade high interest rates and the spectacular collapses of major industry players, including FTX. Despite a string of documented frauds, the most ardent proponents remain undeterred, with firms like Galaxy Digital projecting a five-fold increase in Bitcoin's value over the coming 3 years. Their optimism hinges on several key drivers: the upcoming halving event in April 2024, an anticipated peak in interest rates, and, most crucially, the potential for an imminent approval of a spot Bitcoin exchange-traded fund. But is this enthusiasm justified, or has the market's excitement outpaced reality? A significant portion of this positive outlook is already factored into Bitcoin's current valuation, making a critical examination of these claims more vital than ever. We will dissect these overly optimistic arguments for a Bitcoin rally, revealing why we believe the foundation supporting a monstrous 2024 for the cryptocurrency is built on shaky ground. We will delve into the precise moment a major financial clearinghouse's website crashed, sparking a frenzy that sent Bitcoin's price soaring, only to discover the shocking truth behind the sudden surge. The past 3 years have indeed been a tumultuous journey for the cryptocurrency market. During the global pandemic, crypto transcended its niche origins, evolving from a curiosity for tech enthusiasts into a mainstream topic discussed on established financial news channels. In the latter half of 2020 and early 2021, as many channeled their government stimulus funds and profits from the GameStop short squeeze into digital assets, Bitcoin soared from below $10,000 per coin to a peak exceeding $60,000. This bubble eventually burst, triggered by the Federal Reserve's campaign of interest rate hikes and a broader retreat from speculative assets like technology stocks and special-purpose acquisition companies. However, 2023 witnessed a reversal of fortunes. With less confident sellers purged from the market, only the most unwavering crypto advocates remained. Furthermore, bulls perceived a series of significant victories for the crypto sector. In July, a court sided with Ripple in a case brought by the Securities and Exchange Commission, ruling that the cryptocurrency should not be classified as a security. More recently, Bitcoin's price has climbed in anticipation that the SEC might approve various Bitcoin ETFs, including proposals from prominent issuers such as ARK and BlackRock. In theory, such an approval could profoundly expand Bitcoin's adoption among mainstream investors and significantly boost its price. October saw developments in the ETF approval process make headlines, driving Bitcoin's price up by 30%. We will now scrutinize each primary argument presented for why these developments are bullish for Bitcoin and assess their validity. On October 24, Galaxy Digital published a research paper advocating a bullish outlook for Bitcoin, predicated on the potential of an ETF. Galaxy Digital, a New York-based firm founded by billionaire Michael Novogratz, primarily engages in crypto trading, lending, mining, and asset management. Given their direct financial interest in the crypto market, more trading on their platform translates to greater revenue and the virtually limitless resources of a founder who even sports a crypto tattoo. They are seemingly well positioned to offer expert insights into the current state of cryptocurrency. In their report, Galaxy Research associate Charles Yu posits several reasons why the new ETFs could ignite a 74.1% rally in Bitcoin's price within a single year. Moreover, he predicts that beyond this initial 74.1% surge, there will likely be a much larger impact on BTC demand from second-order effects of a Bitcoin ETF approval. The core of his assertion is that Bitcoin ETFs will offer a superior investment vehicle for many investors, leading to billions of dollars in inflows into these ETFs, which will then exert upward pressure on Bitcoin's price. Even employing what they termed conservative assumptions, Galaxy projects $14 billion in inflows into a Bitcoin ETF in its inaugural year, accelerating to 3 times that amount by the third year. Based on their methodology for arriving at the 74.1% first-year price increase, this would imply a 423% 3-year price appreciation. Beyond the projected inflows, Galaxy expresses extreme optimism regarding the timing of a Bitcoin ETF approval. Alex Thorne, head of firm-wide research at Galaxy, articulated his confidence, stating that the SEC's re-engagement with applicants who refiled in June or filed for the first time, like BlackRock, all align with a March timeline. He questions why the SEC would deny applications in January only to approve them in March, suggesting no material changes would occur in that 2-month span. The prevailing thought, he explains, is that the SEC would process all applications by ARK's final deadline, which is the earliest. However, Thorne believes approval could come even sooner. The initial application for a Bitcoin ETF, submitted a decade ago by the Winklevoss twins, co-founders of Gemini, reportedly received no response from the SEC. In stark contrast, with the latest wave of applications, the SEC has actively engaged with applicants, requesting clarifications and additional details about the proposed ETFs. Alex Thorne views these interactions as highly favorable indicators for approval, suggesting the SEC is taking them seriously. This optimism reached its zenith in late October when speculation intensified that BlackRock's ETF was on the cusp of approval. The catalyst for this speculation was the ETF's listing on the website of the clearinghouse Dtcc. Observers believed this signified the commencement of the process for listing the ETF on public exchanges. So intense was the scrutiny of the Dtcc website that it crashed under the weight of high traffic. The ticker even vanished from the site for several hours, causing Bitcoin's price to dip by approximately 3% before recovering upon its reappearance. This chaotic episode fueled Bitcoin's largest rally in months, propelling the coin up a total of 30% in October to an 18-month high. The critical flaw was that this speculation was entirely baseless. Dtcc confirmed to CoinDesk that the ticker had actually been listed on its website since August, 2 months prior to the sudden surge of attention. For reasons unknown, people only noticed it in October, and the mere presence of a ticker on the Dtcc website holds absolutely no bearing on the SEC's approval process. Despite its official-sounding name, the clearinghouse Dtcc is a private entity that simply provides clearing and settlement services in financial markets, operating entirely independently of the SEC. Phil Back, CEO of Armada ETFs, explicitly tweeted that a ticker appearing on the Dtcc website means nothing for the SEC's regulatory approval process, a sentiment Dtcc itself corroborated when questioned by various news outlets. Alex Thorn's second justification for his belief in an earlier-than-expected ETF approval is even more peculiar. The SEC's guidelines granted up to 240 days to either approve or disapprove applications. This window would place the approval deadline for the ARC application at January 10, 2024. For other issuers, this deadline could extend as late as March, yet Thorn contends that the ETFs will be approved even before the end of 2023. The earliest application, from ARK Invest, has a mid-January deadline. According to Thorn, if the SEC approves one ETF, it will likely approve all of them simultaneously. If they decide on all applications together, the approval decision for all should be finalized by the earliest deadline, which would be mid-January. The approval process is complex, and the SEC, he argues, would prefer not to postpone it until the last minute. For this reason, they might want to conclude their work before employees depart for Christmas and New Year's, rather than leaving unfinished business to address in the first few days of January. Therefore, he posits, they will instead approve all applications at once before the holidays, well in advance of the earliest deadline. These arguments, to some, might appear to be legitimate reasons for confidence in an imminent Bitcoin ETF. However, let us assume that at least one ETF does indeed receive approval. According to Galaxy Digital, the repercussions would be enormous. For various reasons, they anticipate massive inflows into these ETFs, which will cause Bitcoin's price to skyrocket. The primary argument for the ETF's success is that they supposedly offer a far superior method for engaging in crypto investing. Many investors access investments solely through self-directed brokerage accounts or wealth advisors. They may be hesitant to buy Bitcoin directly due to perceived complications or security concerns. Financial advisors are generally not permitted to directly purchase Bitcoin on behalf of clients. However, they are typically authorized to buy ETFs, and most individuals comfortable buying stocks are also comfortable buying ETFs. Thus, a Bitcoin ETF would open up Bitcoin investing to a vast new cohort of investors who either cannot or choose not to acquire Bitcoin directly. The fundamental flaw in this line of reasoning is that Bitcoin ETFs already exist. A Forbes article even identifies 6 such Bitcoin ETFs currently trading on public markets, including funds from major issuers like ProShares and VanEck. These existing ETFs do not hold actual Bitcoin, instead, they manage portfolios of Bitcoin futures. Futures contracts are derivative securities whose value is derived from an underlying asset, in this case, Bitcoin. One can conceptualize them as analogous to owning a call option and shorting a put option, providing upside exposure if Bitcoin's price increases and losses if it decreases. Consequently, investors can achieve nearly identical economic exposure to Bitcoin through Bitcoin futures. The SEC's rationale for only permitting ETFs to hold futures instead of actual Bitcoin stems from the unregulated nature of Bitcoin exchanges. According to SEC Chair Gary Gensler, futures markets are battle-tested and have proven robust against issues like market manipulation, thus offering a much safer environment for investors. Furthermore, the performance of a fund is said to be largely unaffected whether it holds actual Bitcoin or its futures. This leads to the second argument for why Bitcoin ETFs will be a massively bullish catalyst for Bitcoin. According to Galaxy, the total addressable market, TAM, of new Bitcoin ETF investors encompasses broker-dealers, banks, and registered investment advisors. Collectively, these three groups manage nearly $50 trillion in assets. Galaxy makes the assumption that after 3 years, most of them will have adopted the Bitcoin ETF. Additionally, they assume that 10% of the total available assets within each group will opt to adopt Bitcoin ETFs. For each adopting investor, Galaxy further assumes that, on average, they will allocate 1% of their portfolio to Bitcoin. Therefore, 1% of 10% of a mostly penetrated $50 trillion TAM yields approximately $40 billion in net inflows over the first 3 years. Simple, right? This analysis, in our view, is profoundly flawed in multiple respects. Their entire analysis rests on 3 assumptions for which they provide virtually no explanation or justification. Why would one assume that 10% of the wealth held in banks, broker-dealers, and RIAs will suddenly begin purchasing Bitcoin? Where did this 10% figure originate? There is no analysis behind what percentage of these assets are already held by investors who own Bitcoin through other channels, for instance. To simply begin with a massive TAM encompassing the assets managed by the entire banking, broker-dealer, and RIA industries, apply a couple of percentages, and conclude with $40 billion in net inflows into Bitcoin ETFs is, in our opinion, fundamentally unsound. Moreover, it's not just illogical. We can examine examples of ETFs that directly hold Bitcoin, known as Spot Bitcoin ETFs, which have been approved and are trading in other countries. For instance, the Jacoby FT Wilshire Bitcoin ETF trades on the Euronext Amsterdam Stock Exchange and holds substantially all of its assets in long-term Bitcoin holdings. It has a grand total of well under $2 million in assets under management, AUM, that's million with an M, not AB, and on most days, 0 shares trade hands. While this particular ETF is only accessible to professional investors, Galaxy's analysis suggests that professional investors would constitute a very large portion of the total addressable market. For example, banks and brokers serve numerous high-net-worth individuals and institutional investors who would absolutely have access to this type of ETF. Yet, at least in Amsterdam, the inflows into that ETF have amounted to literally a fraction of 1% of what Galaxy predicts for a US-based Bitcoin ETF. Closer to home, spot Bitcoin ETFs have been operating in Canada for years. For example, Dtcc has been trading since early 2021. Yet, Dtcc's total AUM is $1.5 billion. Compared to the relatively thinly traded spot Bitcoin ETFs in other countries, it seems unreasonably optimistic to simply assume that a spot Bitcoin ETF in the US will experience a massively more favorable outcome. But let us concede for a moment that the projected inflows into a Bitcoin ETF do materialize. What would be the impact on the price per coin? According to Galaxy, we can look to the price sensitivity of gold to inflows to predict what will happen to Bitcoin. There is approximately 9 times as much money held in gold investment vehicles compared to Bitcoin investment vehicles. For this reason, Galaxy asserts that each dollar of inflows into a Bitcoin ETF will have 5 times the impact on Bitcoin's price. Based on the historical first-order correlation between gold inflows and price changes, the $14.4 billion of first-year inflows into a Bitcoin ETF that Galaxy predicts would imply a 74.1% increase in Bitcoin's price. This number would surge to 423% after their 3-year prediction of ETF inflows. The notion of Bitcoin's price more than quintupling in 3 years, soaring well over double its all-time high, purely on account of ETF inflows, is absurd. Economics 101 dictates that the price of any asset in a free market is determined by supply and demand. Galaxy's assessment of ETF inflows addresses the demand side, while its comparison of price sensitivity to that of gold only indirectly accounts for the supply side through the correlation between inflows and price. Gold and Bitcoin trade very differently, obviously, with gold boasting over 20 times Bitcoin's market capitalization and significantly less of it changing hands on any given day. Furthermore, they are traded by distinct types of investors for vastly different purposes. These are all crucial factors in determining what each dollar of inflows means for the price of the security. The point is, regardless of the inflows, the effect on Bitcoin's price remains highly uncertain to anyone possessing a modicum of intellectual honesty. The Galaxy Digital article concludes with a note stating that other factors will also contribute to the bullish effect of Bitcoin ETFs in the coming months and years. The author specifically highlights the Bitcoin halving event in April 2024 and the possibility of falling interest rates as reasons why 2024 could be a significant year for Bitcoin. In reality, the halving event will likely have only minimal effects on the price. Each halving event, occurring approximately every 4 years, reduces by half the amount of Bitcoins awarded to miners for each block of transactions. This slows the rate at which new Bitcoins are created. However, this rate is already insignificant relative to the total supply of Bitcoin. In fact, compared to a total of about 20 million Bitcoins in circulation today, only 1.5 million Bitcoins will be created over the next 100 years. That's less than 10% of the total supply over the next century, meaning the halving event represents a relatively small change within an already insignificant aspect of Bitcoin's market dynamics. The past year's massive Bitcoin rally, partly fueled by anticipation of the 2024 halving event, has likely far overshot the actual impact of the halving.